If you can't articulate something on the page, then you haven't thought about the problem enough. So if you're struggling to write, a 30-page, memo on your business, you haven't thought about your business enough.
Hi, welcome to the 43 North Latitude podcast. My name is Nicole Camarre. I am the VP of Investments and Platform here at 43 North, and I am welcoming Jaxon Stuart, Principal at Spacestation Investments. Jaxon, thanks for being here.
No, thank you for having me. I feel like we have a special connection to 43 North because we're not only pre-seed and seed stage investors in Food Nerd, which I know is a shared portfolio company, but we're also customers with Veravend, which also went through the 43 North program. So anyways, excited to be here. First time in Buffalo. And appreciate you having me.
Yeah, we're super pumped. I was just giving you a bunch of tips on where you have to go check out, like things to go and see here in Buffalo. So first trip here, hopefully many, many more.
That's right.
But why don't you tell us a little about Spacestation Investments? You're flying in from Utah, so not necessarily the coast, but you're a bit of a ways from home. So tell us about what you guys do.
Yeah, so I feel like we have a branding issue at Spacestation Investments because we have nothing to do with space. In fact, we invest in consumer brands, in consumer technology businesses. But I can give you a little bit of the historical story and then just slightly touch on my background. So we were started and founded by a YouTuber of all things. So between his channel and then his daughter's channel, they're making content in the family fun friends ecosystem and crush on YouTube. And, YouTubers, you generate cash flow and you look at the journey of an athlete. It's very similar to that of a YouTuber's where, you're in the limelight making a ton of money. Everything's great, but it can all fall off the cliff if you get injured as an athlete or as a YouTuber, if you get canceled, no longer become relevant, whatever else. So with that in mind, we wanted to diversify the cash flow that we were receiving from the YouTube channel. And I say this is the two founders at this point, our YouTuber, Sean McBride or Sean Duras, and then his co-founder, Sean Holiday, who goes by Holiday because you got the two Seans. So yes, very helpful. So they came together, built this YouTube channel, wanted to diversify outside of just YouTube, and built initially an influencer marketing agency because that was kind of within the creator economy. And what we did with Sean McBride and his YouTube channel, we could do for other creators. So started that agency, has now been running for 8 years, one of the top agencies in the US, working with your biggest brands like Athletic Greens, Nintendo, Nikon, but then plenty of our earlier stage portfolio companies as well. We also have like an esports team and a CPG agency, Space Station CPG. We have an animation studio and a bunch of other things underneath the Space Station umbrella. But really where investments started was about 6 years ago, where we invested early into Magic Spoon, which is also based here in New York. And at the time, the two co-founders were probably the smallest check on the cap table, but punched way above their weight in terms of the value that they brought to Magic Spoon because they were seeding product out to our network, which happens to be a lot of YouTubers, mommy bloggers, influencers, professional athletes, folks like that, who liked this low sugar, high protein cereal. So anyways, we cut a small check. First time we ever invested in a company outside of the Space Station ecosystem, started adding value, and didn't cut another check for another year. But then Gabby and Greg, the two founders there, come back to us and say, hey, we're raising a Series A. Business has been on fire. We'd love to have you guys part of the round, but you have to actually bring some real capital, not some dinky, small angel check. Good game on. So we're like, man, well, we can't meet the minimum investment on this round, but can we syndicate it, go out to our friends and family, invite them to invest in Magic Spoon, this brand that we're so excited about. And that's really like where Space Station Investments started. So we put together our first $1 million check, which seemed like a crazy number at the time, invested into Magic Spoon Series A, and continued to run our value add of seeding product out and talking to creators and athletes about this unique brand Magic Spoon. So that was really the starting place of Space Station Investments, and it's since just been a flywheel ever since that case study. So I joined the team 4 years ago this month, and I bring a more traditional finance and venture background. And together we've been, really scaling out our syndicate model. So we've been spinning up SPVs, investing deal by deal into consumer brands and consumer technology businesses over the last, 4 years, and have really focused on our unique value add of bringing creators and athletes into these consumer brands, which helps on the customer acquisition front, the community building front, all of those things. So
great. Talking about before, Coming from like a software background, not really in the CPG brand world, it's definitely new for me, but it's so interesting because like there's so much value in that. And, given that your two founders really didn't come from the venture background, but they really understand, how building a brand works. That's such a huge value add that I'm sure probably not a lot of VCs, VCs come in and they talk about, we've got this network, but the services side of what they offer, it sounds like you guys are incredibly helpful to them.
Yeah. A unique thing about us is you look at other venture groups and oftentimes, they'll have sharp elbows because everyone's fighting for the same deals. And like, I get that. And
you guys get to be the nice guys. Like, we're just going to do design work.
We really are the nice guys, like where we can collaborate with a lot of other investors and be value additive to, the founder, the cap table. And there's multiple examples in our portfolio where a round is completely filled up with, one investor or maybe just a handful of investors. But we get board approval and a signature from all of the investors saying, like, actually, we would like the space station to come on because we have this unique value add that, other investors, their network, they weren't founded by a YouTuber. Their networks aren't in the creator economy. And that's where we were built. So that's what makes us unique and, how we get access to great deals, but then also, how we add value to founders.
That's great. So you guys are pre-seed to early stage. What check sizes do you like to come in at? What's your sweet spot?
Yeah. So pre-seed to Series A is our target. We're actually, so we've been running SPVs for the last, 4 years, as I mentioned, put together, almost $40 million through the SPV network, which is great. But we're raising a traditional venture fund right now. Which is going to allow us to just...
So fun to fundraise right now.
Oh, it is so fun. Getting a taste of the founder's journey for sure. But that's just going to allow us to deploy more meaningful checks faster into companies where we have high conviction. So on the syndicate side, we've been a little bit more flexible with our thesis. But when you look back at the data where we've been most successful, kind of, looking back historically, it's definitely been in the pre-seed to Series A consumer core consumer category. And that's exactly what we're going to focus on going for the fund. So occasionally we might be opportunistic on a growth stage round with an SPV, especially if we can add a ton of value with the creators or athletes that we're bringing in. But, 90% of our deal flow and deals that we'll do moving forward are going to be pre-seed to Series A core consumer.
That's okay. So we've got a lot of people in our portfolio as well as just kind of in our network that are interested in starting a brand or consumer, CPG, consumer packaged goods. For those not in the know, lots of acronyms. But when you think about what you're looking for at a pre-seed versus seed, what is it maybe in terms of like, what is it that you're looking for? I know there's probably criteria, but also maybe for the companies out there thinking, okay, what do I need to be at in terms of revenue, or what should I be bringing to the table at this point? Help them level set the expectations.
Yeah. I mean, I think every investor is going to have a unique approach here, but for Space Station, we really focus on 3 diligence categories, and it's in this order. So it's people, product, progress. And, we're always, especially in those early pre-seed and seed stage, like there's not a lot of data to look at. So really what we're looking at is who is the founder behind the brand, and what is the momentum or tailwinds that we see in the market or the type of product that they're building or whatever else that gets us interested in that, this is the right company to back. So that's the pre-seed seed stage. We oftentimes, when there is data to look at for a company, are focusing heavily on margin structure, especially for a consumer brand. Like we've seen so many consumer brands that are, negative net contribution margin, and that's just not a business that can scale.
Yeah.
So, if your margin's not north of 50%, then it's like, we want to see a pathway of how you can get that. And that's a pretty strict thing on our side. As far as like revenue targets, like we're pretty flexible. We have invested in pre-product, pre-revenue founders, but we do like to see some traction take place, especially with a consumer brand that's going into retail. It's one thing to be able to be very successful in Erewhon in LA or in boutique grocery stores in Manhattan, but it's another thing to like enter middle America and be successful there. So when we're looking at brands, like we want to see that if they did go nationwide Walmart or nationwide Target, like they wouldn't just be successful on the coast, they would be successful across the entire US, because that's what makes you interesting to an acquirer like a Unilever, like a General Mills, is that you can reach the masses, not just
big target market, and you got to prove that you can actually hit it. Yep.
Exactly.
Do you think, we talked about this a little bit before too. So listen, you're based in, in the Utah outside of Salt Lake City. We're in Buffalo. We're not in the coasts, right? We're non-traditional markets for venture capital and what that means for startups. And, one of the things, having spent time in those bigger cities, how do you feel about founders that are starting a brand in a place like Buffalo, New York versus in New York? Do you weight one more favorably than the other? And maybe what do you think are some of the things to be aware of if you aren't in a primary market?
Yeah, we're not like we are geography agnostic. So we're not just trying to invest in companies in Utah or just trying to invest in companies on the coast. And there's a lot of other, amazing investors who have built their entire brand on you're very similar. It's like we only invest in companies that are based in Buffalo or have Buffalo ties.
Yep.
And like I think that's great. I think founders coming out of these, non-traditional backgrounds or not non-traditional geographies, not, one of the coasts, you kind of have like a chip on your shoulder and you're grittier, you're a little bit more humble. And I think that benefits you. And it's important to still be plugged into the New York ecosystem and the LASF ecosystem because there's so much innovation and money. And
yeah, Food Nerd is doing that right now, which is so great, right? She's based here, but she's spending time out in LA, I know. Yeah. Which is great.
Yeah, no, exactly. So that's kind of what we look for. It's more, who is the person behind this? Because you can build a brand from anywhere, whether you're in, the mountains in Salt Lake City or right on Manhattan Island. Like you can build a brand anywhere. It's just, doing it right.
We agree. Listen, we've got in a lot of our portfolio. We've got Top Seeds, we've got Twipes, we've got a lot of CPG, and I know there's probably more I should be saying right now, but we're seeing a lot of that being built here. And I think it's great because, to your point, they are grittier. It's, I would say it's a lot more capital efficient to be in a place like Buffalo, building that out. But that being said, it's not that hard, especially in the last few years. We've proven you can hop on a plane or you can get on a Zoom and you can also be connecting to those bigger regions, which is really cool. But maybe when you are working with some of those brands, how are you helping make connections to some of the bigger cities, or even as you're thinking about the investment partners that you guys look to bring on? Yeah. What are some of the skills of those investors that you want to bring to the table with you guys for those founders?
Yeah. We're always trying to bring complementary skill sets where we can bring the customer acquisition side, these influencers and athletes. But if there's another investor who's really good at getting brands into retail and blowing up on that side, like that's like a pretty magic marriage. Where, not only are we getting loud online with influencers and athletes, but we're getting loud in Whole Foods and in Target, which all just kind of like cross-pollinates each other. So we take a bespoke approach to each brand that we're investing in of what are other great co-investors. And, we really do focus on building a great co-investor network because that's not only where we get great deal flow, but it's also where we can send our portfolio companies that are raising subsequent rounds to raise more. So.
That's great. So you were saying, I know we talked about this a little bit before, that you have a really good quarterly call that you have with a bunch of investors. When you're thinking about what you're seeing right now in the landscape of funding, I know, again, on the software side, things are changing pretty radically. Do you see that similarly that funds are starting to go a bit more upstream on the CPG side where there's less at the pre-seed seed? Is that an opportunity for you? I
feel like early stage CPG investing is kind of a lost art. Like there are not very many firms that are out there investing in, pre-product or early traction CPG brands, consumer brands. Which is unfortunate. And there's plenty of firms that have, that growth stage capacity, but their benchmarks are kind of constantly moving with the market. Sometimes a Series A, you need to be doing 20 million in revenue. Sometimes it's 10, sometimes it's 50 for some, investors. So I see that benchmark moving a lot, but I look at Utah and we have so many incredible consumer brands that have started here. Which I'm grateful for, but there's no investors in Utah that are solely focused on supporting consumer brands. So we hope to own that space and kind of build that community more from the ground up, from the pre-seed and seed stage, so that they can grow into the growth stage companies that you want them to be. So.
Yeah. And every fund is different, but when you guys think about like a seed versus like an A, Is there is pre-seed to you like pre-revenue? Do you have like a benchmark? I know, for software, 1 million of ARR was what we used to benchmark kind of that seed and A. That's kind of gone a little bit, further now. We just want to see more. Is that similarly happening for you guys, or what do you guys see?
Yeah, no, I mean, we don't put any really like rigid parameters on it. Like we're very opportunistic, and it's like the naming of different rounds. It's like, I don't know.
Yeah, I mean, a seed versus an A. It's like what I pre-seed.
Yeah, exactly. So it's like we're truly just looking at the opportunity at hand, whether it's a bridge to A, bridge to seed, it's a pre-seed, it's a friends and family, like whatever you want to call it. Like we're really approaching each brand pretty uniquely, and we're constantly looking at different trends and things happening in the health and wellness space. That's probably the most common thread in our portfolio of Magic Spoon, Olipop, Aura Ring, Hyper Ice, Graza Olive Oil. So many great brands in the health and wellness ecosystem. We're looking at trends and then identifying companies that are building in those trends, and then just learning. And then sometimes we'll find like, oh, this one's interesting, like this is the diamond in the rough, like let's go deeper.
Got it. So you're doing more of that thesis-driven investing. Yeah. Do you maybe? Is there anything specifically that you're really excited about that you're just spending time learning more about right now?
Yeah. So this actually relates to a 43-year-old portfolio company.
Love it. Great.
So,
yeah. Hey, lead it in. I didn't even know. I didn't know.
Little shout out there. So I'm probably going to mispronounce the ingredient, but paraxanthine.
We say PX because I actually was trying to figure out how to say it, and you said it this morning, and I felt like a really bad VP of investments for not being able to say it. So PX.
Let's just go PX. So PX is I'm going to do a bad job explaining this, but it's basically a derivative of caffeine. When your body digests caffeine, it splits off into two different things, one that makes you feel bad, and then one that actually makes you feel good. And paraxanthine, or PX, is what makes you feel good. And anyway, so we've started seeing more and more products like Rare Bird replace caffeine in, Rare Bird's doing coffee. We've seen other energy drinks or energy bars replace caffeine with this PX ingredient. And as a user now for 9 months, it's been really interesting to see the difference of caffeine effect on my body. And, I wear my Aura Ring, shout out Aura Ring. I can see the effects that caffeine has on my sleep. Paraxanthine doesn't have the same effects on my sleep as caffeine does. So anyways, that one ingredient is really interesting. And I think what we're deciding on is, like, do we bet on the ingredient or do we bet on, the brand? Because, how hard is it for a Monster Energy or a Celsius or whatever else to just say like, oh, this PX ingredient is a massive trend, like everyone's doing it. It's like, we can just replace it like that. So anyways, that's kind of the judgment that we're going through right now with brands that we're looking at.
Are you actually been looking at like supply chain?
Yeah. It's like who's sourcing this PX ingredient? Like, is there a patent on it? It's like the whole thing. And for anyone in the consumer ecosystem, you've probably seen the news on David's Bar, where they just raised a $75 million round and bought out their supplier of EPG, which is a modified fat, and cut off the supply to all of these other brands. Sharp elbows. Yeah. So it's like they're going through like big lawsuit and everything. Who knows how that's going to turn out? I mean, my guess is it's going to be nothing and it's all just noise. But like that's
been doing that for a while, so
fair enough. It's really interesting though to look at the ingredient and understand where in that value chain you want to invest in. And in the case of EPG, it's like it would have been great to invest in either David, who's the sole user of EPG, or the actual company that provided the ingredient, versus all these other companies that were leveraging it that are now cut off from the supply chain. So
really interesting. Okay. So you like that. So the health and wellness, and then you're doing stuff in wearables as well. So Aura is one of yours, which is really cool. Are you guys spending any time kind of looking at, I guess maybe how much more of your time is being spent on like wearables versus like actually like the food products? Do you specialize in that at all?
Yeah, so like 30% of our portfolio is CPG, food and beverage, and the other 70% kind of falls among the consumer landscape. So consumer fintech, but I would say CPG is majority. So we have consumer fintech, we have some beauty products, plenty of supplements. But food and beverage is definitely at the heart of our portfolio, and it is really like where we built our track record. Like it was that first investment in Magic Spoon. It was early investments in Olipop and Slate Milk. plenty of just amazing food and beverage products. And that's kind of just the community that we've been a part of. And the CPG community is honestly like incredible. Like you go to Expo West and it's truly the funnest conference that you could ever imagine going to, just, gorging yourself with all these samples. And
I was really jealous hearing you talk earlier about like all the things you're trying. I'm like, oh, you get to just try food, different kinds of food all day. Like that just to me sounds like a really great day at work.
But my address is like leaked out. I find like boxes show up. I never talked to this company.
Is there anything you'd like to solicit being sent to your house? No.
Quickly address my address.
But anyways, it's always fun to try products and being able to like actually experience like what a founder's working on. It's hard if you're building some deep healthcare SaaS tool to like really understand what is the impact, or like what is this product doing. It's like but with a a bowl of Magic Spoon, it's like I get to eat that every morning, and I look at the nutrition facts, and it's like I can see the protein that I'm getting and see that I'm not gorging myself with sugar and all this stuff. So anyways, I do love investing in consumer products for that reason. Is it's just very tangible and real.
It's fun. I know you and I both kind of share this background where we come from more of like the VC, finance, PE a little bit too, and then working with like a creative types like your team, like the founders, they're probably very different. So what was it like for you kind of coming in? What was some of the initial learnings? Any like one or two points you can think of in your career where you're like, oh wow, this is a lightning bolt moment for me?
So my first time meeting the entire team in person was at this place that we call Pirate Island. And Sean and the space station had bought this plot of land on this man-made lake up in Layton, Utah, and built truly a pirate island. Like we're talking wrecked pirate ship, playgrounds, skateboard rink, like just crazy stuff. Anyway, so I pull up and I'm like, where am I?
What did I just sign up for?
Yeah, at this place called Pirate Island. Like this is wild. And in that meeting, we were just talking about kind of the like building Spacestation Investments and what do we want this to be. And the phrase that kept coming up was sauce. And I'm like, what are they saying? Like we need to put sauce on it? Like what is sauce? And I finally at the end of the meeting like understood that it's like sauce is just what makes you unique. It's like, how can we pour the space station sauce on the brands that we invest in? We do that by seeding product out to our network or developing unique ways to outreach to influencers and athletes. Like with Magic Spoon, we, helped develop the viral bowl and spoon, the rubber bowl that they have, and then the neochrome spoon. So that was, a viral moment on YouTube that we helped develop. So just like stuff like that, that is the space station sauce, as we call it. And I think every brand like needs to find their sauce, and that's the art and the science. It's like there's really like three hards with building a consumer brand. It's having a great product, it's operating lean and efficiently, but it's also just being unique, having a brand, having a community, having customers that want to come back and are retained, all of that. So
you help them find like their ideal client profile, or do you expect them to kind of know that, like they have that ICP pretty nailed down before they come to you?
ICP,
like just like they're the ideal client that they're selling into. So like you say, like, right, this is like a mommy, like this is kind of like like with Food Nerd, right? Like it's healthy food for kids, right? And it's going to resonate with the mommy, environment.
I think again, like that is a little bit more of the art and science. It's like it's obvious to assume that a food nerd would resonate with mommy bloggers or folks that have kids, right? But I'll give you an example with Oats Overnight. We ran some influencer marketing with them. And we've invested in them since the very first round of funding, and they've since grown to be a massive brand. And on some of those early influencer marketing campaigns, you're initially thinking, oh, I should target health and wellness influencers, or people that would resonate with a convenient, quick, healthy breakfast. Okay. And that's true. Like, and those people performed. Where we found one creator that really performed like 10x plus ROAS on all of the dollars that. ROAS, return on ad spend. So yeah, whether that's Meta or an influencer, it's just kind of a KPI that we look at. So with this one creator, she was a like nail tech. Like she did crazy cool acrylic nails, and she talked about Oats Overnight, and her community loved it, like really resonated with it. But that was not an obvious choice if you were going to build an influencer marketing, campaign for Oats Overnight, that she would not have been an obvious choice. It would have been your mommy bloggers who need a quick on the go, breakfast. It would be your health and wellness people who are looking to increase protein and not have a donut for breakfast. So anyways, it's again, like a little bit of that art and science combination.
Is that a little bit of like, did you luck into that, or was that something we're going to test a couple of different influencers we know? How did that come about?
Just a test. And I don't run any of our influencer marketing. That's Trav and our co-founder Holiday, but like they're truly world class at that. But yeah, it's really just testing with brands. Like that's what we have to do, is just start seeding, little ideas out to these creators communities and seeing what resonates, and then double down on, partnerships or co-branded agreements or whatever else.
Okay. Maybe talk a little about some of those go-to-market channels that you might be finding. So some of your customers, I'm sure, just going direct to consumer versus maybe having more of those retail partnerships. Are you seeing any of that changing right now in terms of what's the market and the appetite in the market?
Yeah, we have like case studies in our portfolio of two extremes where, one, you're scaling a business straight direct to consumer and then releasing retail. Others that are only focused on retail and then releasing direct to consumer. So Magic Spoon's a great example. They were not in any retail channels until more recently. So they scaled to a pretty massive run rate straight direct to consumer. But then when they did turn on retail, it was nationwide launch with Target, nationwide launch with Sprouts, nationwide launch with Costco, with Whole Foods. So like their impact was much greater because they had all of this success on the D2C side. Other brands, like I'm looking at, Painterly and Sisters. This is a yogurt company based in Pennsylvania. They don't have any direct to consumer component because it's hard to ship yogurt across the US. So they're working on turning that on just to service, customers who want that. But, they've solely focused on scaling the business in retail and have been really successful at that, proving out in regional channels, but then getting nationwide launches after showing regional data. So anyways, it can be different for every brand. I think for most brands, especially, a CPG company, people buy their groceries at a grocery store. So you want to meet them where they are, and you don't want to get in the loop of, having to spend, thousands, tens of thousands, hundreds of thousands on Meta just to acquire a customer. So yeah, I would recommend most people look at retail and take that very seriously, but you can do it both ways.
Yeah. We've talked a bit about the manufacturing side a bit too. When someone's coming into you and they're saying, I'm not sure if I should go the co-manufacturing or co-manning route versus just building a manufacturing plant myself. Maybe talk a little about, I know you've seen it both ways, but yeah. What are the pros and cons that you see on going either way?
Yeah, well, one, building your own is expensive. And if you're an early stage brand, typically you can't bring on debt. So you have to sell equity, and that's hard. But, I look at, Food Nerd as a great example. They're building their own manufacturing. They're an early stage brand, and, are funding this with equity, right? But, we see that as a massive moat for Food Nerd, not only because they have unique technology, but because now no one else is going to be able to replicate what they can do. And, the investment required to get their co-manufacturing up and going is less than you would, maybe imagine. From some of these big food aggregators that have $100 million lines. It's like that's not what Food Nerd has today, but eventually they'll become that. So yeah, like that's on Food Nerd side. I would recommend like every brand just really build a close knit relationship with manufacturing, because that's how you'll get better margins, the best product, innovate better. So whether that's with a co-manufacturer or you're building your own, I think just having closeness to the manufacturing process is pretty critical, because at the end of the day, if you can't manufacture a great product with great margins, like you don't have a business. So
how do you go about evaluating a co-man? Is that something they should be? Is it about, right? Like, are they providing financing terms to you? Are they giving you relationships to potential go-to-market channels? Is it really just about the unit economics? How do you evaluate a potential co-man?
Yeah, I think it's more on, who are the co-mans that are willing to truly partner with you, especially for an early stage brand. It's like every, co-man is going to have, minimums or whatever else. But when we talk to brands where they have a really unique relationship with their co-manufacturer, because either the co-manufacturer, believes so much that they're investing, or they're just dropping minimums, or both. Like that's an interesting piece, because manufacturing's hard. Manufacturing's hard and it's expensive. So if you can get that right relationship, like that's attractive from an investor perspective.
Yeah, that makes sense. I mean, it's also right now, I'm sure it's always hard to manufacture, but especially I think right now, kind of in the macro climate, it's probably even more expensive if you were taking out, debt or equity, however you're financing that, and you're trying to build a production facility. It's become even more expensive right now. Are you guys seeing any changes in your portfolios or impacts, just kind of given some of the inflationary environment, or just things happening kind of across the country?
Yeah, I mean, tariffs are a thing. Many of our brands manufacture, or at least have parts that come out of China, and that's been a discussion that we've had with a lot of our brands. And I think what's been impressive across our portfolio is just the resiliency. And when you come in with, like a great margin structure, it's like a 15% hit or whatever else, like it's material, yes, but it doesn't, default the business. So, we're rolling with the punches with our portfolio companies, but most of them are in a really good position, both on their balance sheet, but then also how they've set up the business and their margin structure to be able to work through things. And it's like always just have a contingency plan. It's like if you only have one manufacturer or one supplier, make sure you have that plan B, C, D. And we've seen that, happen multiple times where, your co-manufacturer goes out of business and you don't have any relationships to continue to scale production. And then you miss out on servicing your nationwide Target launch that you said yes to. And now Target's pissed and now you can't go back into Target.
That's really good advice. Oh, that's...
Yeah, always have A, B, C, D plan. You go all the way down the alphabet, have 26 options of, different co-manufacturers, different ingredient suppliers, whatever else, just so that no matter what happens, if your manufacturing facility burns down, that happened to one of our portfolio companies, like truly, like the acts of God, happen. And,
I mean, that's the thing, though. If you've seen enough deals, and that's where I think, venture investors can be so helpful, because if you're a first-time founder, you don't know what you don't know, right? We'll sit here and tell you to talk about unit economics. We can sit here and talk about the macro climate, but like, if you've been investing for a while, you're just going to see things go wrong. Like that's what you consistently see. So that's really great advice on just having a list of different people in your supply chain to be focusing on. I think other things that are happening right now are, maybe talk a little bit about the financing environment for your companies. Are you seeing any of that changing? So for your portfolio companies, maybe they're starting to outgrow you guys. Is there anything changing in terms of the follow-on financing environment?
Yeah. I mean, we are, seeing a lot of M&A activity right now, which is exciting in the consumer space. And I think everyone is either experiencing exits or looking for their top companies to experience exits. But as far as like growth stages in our portfolio companies, we're seeing kind of two sides. One is they've built such a profitable business they don't need to raise additional capital, and those are kind of like the silent killers that are just growing at an incredible pace and have built an amazing business, but there's not a lot of the PR about new fundraising or whatever else. But then one day you're going to hear that there is going to be a billboard article or announcement about them being acquired or going public or something like that. So there's one side. The other side is really our companies are raising additional rounds of capital to double down on growth, especially as there's been kind of like a clean out in the CPG and consumer products industry as funding has dried up. It's really left only the kind of strongest brands to survive. Yeah. But there's still a lot of venture funds out there that have money ready to deploy, especially at the growth stage. Consumer has a lot of great growth stage investors. It's really lacking on the pre-seed seed stage.
Yeah.
But a lot of great growth stage investors, and yeah, we're seeing a lot of activity from those.
Great plug for Spacestation Investments on 43 North in terms of funding at the pre-seed and seed stage. Yes. No, that's great. Maybe we've talked a lot about like the funding environment, but maybe as you guys are coming in and working with your portfolio companies, you're working with them on branding. What are some of the other things that, in terms of connections, we've talked a little about, corporates and maybe making those connections for them. What other things are helpful for founders to be thinking about as they kind of hit that early stage that they might need to start spending more time on?
Yeah, one thing that I've consistently told founders especially at early stages, and this translates into growth stage as well. But most investors that you're going to talk to are going to write a deal memo on your business. And I'm such a believer that writing equals thought. And if you can't articulate something on the page, then you haven't thought about the problem enough. So if you're struggling to write, a 30-page, memo on your business, you haven't thought about your business enough. And being able to articulate that, I think, just helps you in conversations. It helps you pitching. It helps you, across so many different aspects, because you're being very intentional about it. And you're doing a lot of the legwork for the investor. The investor is going to take your pitch deck and take all the market research that they're going to gather and write a deal memo. So go do that work for them. And maybe you'll identify unique things about what competitors are doing or whatever else. So that's what I would kind of say is what we love when founders do and what we recommend founders do. Even if it, doesn't get into an investor's hands, I think the practice of writing down and thinking about your business can be transformational.
Oh, I couldn't agree more. I know when we've been writing memos in the past, it's like, if you can make someone's job easier, give them the information, like, help me help you. Like,
Yes.
that's just a life lesson. Like, if you can help me, it's going to make me want to help you. Number one. Number two, it's going to show me what you're like to work with. Right? Once you get, once I'm on the cap table, we're married now for a while. So you need to see what we're working with.
It's a 10-year marriage.
It's a 10-year marriage. So you need to know what we're working with. And I think it's also really important, this is my own piece of advice to it, but I think, when you're putting all this information into, like, helping me develop, like, the market landscape, like, provide your sources, like, I like the transparency bit. That's a philosophy for me, but it's, if I can come in and see, like, hey, not only did you do the work for me, but I also trust where you're pulling your information from, like, it shows me you're thoughtful.
That's it.
I think it's super, super helpful. And to your point, it's like, if you do that work for me, it makes it really easy for me to go to an investment committee and hopefully get a yes.
Yes. No, that's it. It's like the easier that you can make an investor's job to say yes is, going to get you closer to actually raising capital.
No, I agree. So thank you so much for being here, Jaxon. It's been great to have you. And we're really excited to see all the things that come out of Spacestation Investments, especially with Food Nerd, which I know is going to be opening their production facility this week. So thank you for joining us today. Thanks for your support. And thank you all for listening.